All right, check, radio check. We're going to go ahead and get started. Keep an eye out for people coming in. This presentation, normally I'm about 15, sometimes 20, 25 minutes, but the topic I may start to go down a little bit of rabbit holes. So because of that, I may end up going a little long. So I will apologize in advance if I do, but if you got to hop off, I get it. So without further ado, we're going to talk about the Taxmaster money move. And for me, this is this is important. When I'm dealing with clients, helping, people quite often will think it's always about the rate of return. What's the rate of return? What are the costs, the loads, the fees? And although those are important, was just on New Jersey 101.5. And when Eric asked me, he goes, what one thing would you like to share with the audience? And the thing that I would sort of comes foremost to mind is it's the taxes, it's the taxes, it's the taxes. So with April 15th on Monday, I felt it was apropos and timely to talk about this. If you don't get it, this will be recorded. I will tell you, I just did this with a client yesterday. And I will go at an accelerated pace, right? Because it is my goal is not to help you to build a watch. It's sort of on a high level, help you to sort of think about things a little bit differently than what we've done in the past. So without further ado, we'll get started. So Albert Einstein is quoted as having said, one of the hardest things in the world to understand is the income tax. And I would agree. And so, he's also quoted as saying one of the most powerful forces in the universe is compounding interest, velocity. And so this chart really just demonstrates the impact of a compound, right? If we were to sit here with the calculator, right, and you could see here while we're talking about it, turn around and double that dollar for 20 periods, right? One becomes two, two becomes four, four becomes eight, and we continue on down the line for 20 years. You would have that dollar would have turned into over $1 million, and that's compound. And intuitively, we know that that's important, and it's how wealth is created and made. But nobody can invest for free. And everybody is as astute as they are, and I have a lot of very sophisticated and highly educated clientele. And they quite often will gravitate towards the fee, or what are the fees, and you get what you pay for. But nobody ever really seems to command the importance of taxation. So the importance of this slide here is that, if you step out of line one time, especially towards the end, and I used to talk about this because, a 529 is a perfect example. People save in college plans, college funds, tax-free, low cost. Okay, it's checking all the boxes. But then in year 18, 17, or 16, they get out of line to pay for a college. And when you do that, you lose the compounding effect of the interest and you have to start again. And that's really the greatest takeaway for everybody here today. So, the other thing I want to point out is, our tax environment. So on the left side of the chart is what our tax environment used to be. The right side, the graduated cylinder for a married couple filing jointly, is what our current tax environment is. But on 1/1 of 2026, it is going to go back to the left. And so that's if things, taxes, this is already law, right? So there's not speculation here. That's not even taken into consideration. The next slide, which is, or the two slides for now, which is our national debt. The other thing I wanted to point out to you, if you've ever sat with me, we've talked about the horse race, we've talked about taxable annually, tax postponed like an IRA, 401k, 403b, or tax free. Tax postponed and tax free, if the tax environment when you take the money out is the same as when you put the money in, we end up with the exact same thing mathematically. But a little known and understood, and the purpose of today's call is the blue horse. So notice that the blue horse runs out of money. And why is that? And that's because of the taxes. It's the taxes. It's the taxes. This is the chart. This is from last year. We are now at 34 trillion. It is just unchecked spending that our government, they're addicted to spending. You know, that's 32 trillion. There's a lot here. You can go see it running real time, usdebtclock.org. This is all every household member, mother, father, grandparent, child, brother, sister. This is every person's, U.S. combined household debt. And then we got income, right? What's our income revenue coming in? And this is our tax revenue. So you don't need to be a math major to understand that the U.S. government has a spending problem. And if I ran my business the way that the government is running the country, I would have been out of business 15, 20 years ago. But they can print money, I can't. So let's get into when taxable accounts generate interest or dividends, there are three ways to pay the tax. First of all, we can have an increasing tax liability, or we could turn around and pay a level or a flat tax, or systematic tax reduction. Now, the following illustration is intended to show the performance of compounding interest in a taxable account compared to a tax-favored environment, the blue horse, right, that I was showing earlier. And then everything I hear is hypothetical. So I had a client come in yesterday. He'll remain nameless. He and his wife came, but he is 64, and he sold the farm. And his share of the farm from his parents is $500,000. And I said, okay, 5% it will be the growth rate going into an investment account. And we could just put that at a bank right now. We can get a CD at 5%. And then a tax favored account, we would treat the same way. And then we're going to talk about something called opportunity costs. And a lot of people think they understand it. So we're going to dive deep. And I kept the taxes even, 25%. Ordinary tax bracket, and the same for all that as well. So what this is just showing is compounding. So again, this is where I'm going at an accelerated pace, and I apologize if I go too fast, but all we're trying to say is if I take $500,000 and I do this for 30 years, at the end of 30 years, I have $2.1 million. Woohoo! I'm rich. I'm a millionaire. So a 64-year-old, and I ran out to life expectancy, 94. Right? 30 years. I don't know how long he's going to live. I just wanted you to understand the impact of uninterrupted compounding. But again, nobody can invest for free. And where we save our money and grow our money matters. So when you compound interest in a taxable investment, your accounts will grow dramatically. The taxes increase along with the growth of your investment. The next screen illustrates not only the growth of the account by year, but the increasing tax burdens that's associated with the lost opportunity costs as well. So what I did here is I wanted to go really slow, because this part here, I think, if I gloss over it, I'll lose you later. So if in year one, I had $500,000 at 5%, I basically made 25 grand, of which I owe taxes on. I do the same thing, and now in year two, I will have paid the taxes. 6563 times 12, or times 2 is $12,813. That's the point. I have to pay taxes if I put it into a regular checking account or CD, right? So notice at the bottom here where I turn around, if I grow that out, that 5% for 30 years, the total aggregate amount of taxes on that account is $415,000. We're not pulling the money out of the account. We're pulling that from lifestyle. So that bill is being paid. But I wanted, in order for us to do a fair assessment, we have to make everything equal. But let's just do a little math here. If we know that 500,000 at 5% is going to grow to the end of year 2.1 million, how is my net over here 1.3? Because mine is 400, I'm missing something, right? So what that is something called lost opportunity cost. So that allows me to go back to the beginning to help you to understand that on that $525,000 in year two, right? There was, what it's saying is if I had not had to pay the government the taxes, I could have taken that money and gotten a rate of return of 5%. I lost that as well. And that's a hidden wealth transfer that most Americans never wrap their heads around. I'm not saying that it's beyond comprehension, but they just don't think about it. So that's where the $313 comes in. And you go, well, in year two, that's not a big deal. Who cares? But over time, right? That 415 combined with 356,000, because that's all tax money that could have generated revenue as well. And had it been done in a tax-free environment, that could have been kept in your family circle of wealth. That's $700,000 between the two, and that's the differential or the delta there. So 1.3. All right, so what are the alternatives then? So there's basically two paths we can follow. There's a strategy called the flat tax alternative, which basically, before I get to the screen, just think about it like this. Basically, what we're going to do, if I have $500,000 and I know I can get 5%, I'm going to back out the differential, whatever amount I would have, to get me back to $500,000 at the end of the year. So basically, in essence, I'm stripping off the earnings and putting that to work. So to fully understand the value of the flat tax strategy, the accumulated value of the withdrawn interest must be added back to the original principal. In our illustration, we are assuming the interest from the original investment, account one, is invested in a tax-favored account. So that's key. Account two, notice the taxes are constant or flat. So here's what happens now. When we flatten it, our $500,000, notice that the beginning of year balance is 476. That's because we pulled out the differential to get us back to $500,000 at the end of the year. We took that money and we turned around and we invested it in account two, but we still owe the tax on the 23,810, right? So that 5952 over time, right, adds up. So that's all in year one. But as I go through now and I start to say, hey, now I got my year two, notice that I have a little bit more total taxes paid. It's just going to grow as we proceed. And notice there's that column again, lost opportunity costs on the tax. That's where that triangle came in right next to the 25%. So this is showing the lost opportunity costs. Now, as I start to factor in account two, where are we putting the money? So as I start to put the money in, notice that the net account one plus account two minus the taxes minus the lost opportunity costs, I'm better than I was had I been in a CD or 1.3 million. So I've improved, and this is just the math behind it, right? So that basically taking that account, putting it at tax deferred, but because of the environment I am forced to save in, notice it's tax deferred. It's not tax free, it's tax deferred. At some point in time, those taxes will be due. Okay. So we win. And to me, over this time frame, depending on how we do, helps the family overall. This is the documentation. I can support everything that we're going over mathematically. As I mentioned before, Circle Wealth allows me to go in and build a watch if I need to. But just understand that that's where the 1.5 going across the top, we have our annual earnings. The balance at the end of the year is 2.1. Total tax paid from lifestyle, 178. Lost opportunity cost, 216. Deferred tax liability, that's where basically $600,000 off the 2.1 thousand gives us 1.5. It's better, right? Is it the best we can do? Well, that brings us to option number three. Option number three is reducing the tax alternative. And the reducing tax alternative, as the principal declines to zero, the amount of earnings in this account and taxes paid on those earnings decline as well. The next screen shows the withdrawal of interest and principal from the original account. This amount is reinvested in a tax favorable, not tax deferred. This is, and it's just a technicality on words. I like to say, if it is in fact tax free, but it does matter how we title the account or the vehicle that we save it in. So account 2, the balance of sum of accounts 1 and 2 is also shown. So the first strategy is, hey, Chris, can I move this money with the stroke of a pen into a tax deferred vehicle? And the answer is yes. And what would be the benefit? So instead of putting the money into a CD where I got a 1099, could I kick the can down the road? And the answer is yes. And in year 1, you see some 600. I'm going to go back here. You see we got deferred tax 6250, but then at the end of it we end up with 2.1, same 5% growth. I deferred 415,000. So I win, I get ahead here, right, at 1.7 million, right? My reluctance or my hesitancy with the stroke of the pen method is at Professional Planning Services, we are huge proponents of something we call the luck factor. Luck stands for LUC, which stands for liquidity, use, and control. You have to have liquidity, use, and control of your money, in my opinion. But not everybody is eligible for all these strategies. So when we start to look at other alternatives, right? What if we start to spend it down in just enough and a proportional amount over 30 years? What does that look like? And that's what this screen is showing. So in year 1, there's all the math behind it. And then year 2, you can see that now the total tax is paid, but we're slowly starting to spend that down as we fund that tax deferred account. So now we still end up with 2.1 in the tax favored account. Notice the word is now tax favored. And then as I get to go out there now, I'm now ahead of the game with 1.8. But that's still not the complete picture, because again, we still had taxes that had to be paid and the documentation. So the best that we're probably going to be able to do is, we want to get it in as fast as possible. And I will often say to clients, if you had a choice, how quickly would you like to get your money and still have liquidity, use, and control? And I'll get answers anywhere from, the fastest the IRS will let you is 4 years point in 1 day, or 5 years. Or, I have clients that say, you know what, I can handle something over 10 years, sometimes 15, 20, whatever your numbers are, we can run them. But at the end of the day, getting them into an environment, a tax favored environment, is the goal. So now what I turned around and did is I just showed us pulling out, instead of the $30,000 coming out over 30 years, now we're going to try and get that money in as quickly as the IRS will allow. And that's at $109,988. 5 payments equal, and then I'm done. So the tax liability is now gone. And I've paid all the taxes, right? So 5 years, and now that money starts to grow, and then the tax, that column, the total lost opportunity cost on the account on $500,000, instead of it being $700,000, is 36. And now I had $2.1 million in that account. And again, to my benefit. So as we look at the strategies, which is the best, right? The flat tax, the immediate pay down, stroke of a pen, or maybe doing something over 5, 10, or 15 years. There's, sometimes it's a combination of, but my whole point of doing this call was where we save our money matters, and where we put our money matters. So when I'm speaking with folks, right, they'll turn around and say, hey, I want to buy a second home, or I want to buy a bass boat, or what, I really don't need the money, but I hate paying the IRS this excess amount of taxes, right? Whatever your specifics are, that's where we can help you to do an analytical evaluation of your specifics. So at the end of the day, somewhere between a stroke of a pen and these sections of the IRS code bring us to this. So here, if you have a taxable investment where your interest is compounding, you have observed that compounding interest increases taxes. Leveling your taxes creates less wealth transfers. And then if we can reduce the tax liability by repositioning the principal and interest, you can potentially further lower wealth transfers based on the alternative investment results. So this is 2023. You know, you guys all know on Monday, if you're having accountants, if you're doing TurboTax, doing it yourself, you're familiar with this form. But it's this page here. This is what I look at. When clients bring me their, I'll ask for their tax returns. One of the areas I'll dial in at is this section here, 2A and 3A. What are you paying in taxable interest, in ordinary dividends, qualified dividends, all this stuff? This is where I can figure out. And one of my partners just helped a guy who owns a HVAC business out in Chicago. And you know, it's probably he's worth $30 million, right? The business, everything. And when we got the tax return, he's paying close to $900,000 a year in income tax on where his money is being held. So when we got that, bottom line is we were able to improve that situation by slowly utilizing the last strategy that we talked about, and improve and enhance his family's being able to keep more of the nest egg as we go forward. There's solutions for everything, and it's not a cookie cutter approach. Everybody's circumstances are different. You have to be careful about listening to water cooler advice. And this is why I encourage you to deal with professionals. So, you know, there's more to it than just fees and rates of return. It's the taxes, it's the taxes, it's the taxes. Which brings me to, you know, one of the places we will put money is typically into an annuity. Right now, this is not a pitch for annuities, but because of the tax benefits that annuities are offered, I just have a real simplified chart here to help you understand, because, you know, annuities and life insurance are not a four-letter word. Everybody thinks they understand it. Everybody has an opinion. And to me, they're just tools. So on the left side of the screen, we have an immediate annuity. These are things you already may be familiar with. It could be a pension, it could be Social Security, or you could buy a private annuity. And then as they pay out, you could do life only, period certain. You could do a survivor. And that was one of the things I identified yesterday, that this gentleman had a pension option, but he had not thought about leaving behind 50% for his spouse. These are important topics. And then a specified amount. So those are on immediate annuities. That's not where I would put some of this money if it's sitting, because that's where you're trading an asset with an insurance company to get a guaranteed income for life. That is not the purpose of today's call. Where I think strategies belong is in the deferred annuities. And then which vehicle we pick is why you need to deal with a professional. But one of the things I do not particularly care for are variable annuities, right? I don't, this is purely my opinion. I think they're expensive, and I think they're way too risky. And you've all heard that commercial on the radio or TV. I hate annuities, and you should too. It's this annuity here that they're talking about, and I agree. But the rest of them are absolutely really powerful tools. A fixed annuity can't lose money. That's important. But that's guaranteed not through the FDIC, like the banks would have you put money into, but by the credit worthiness of the insurance company. A MYGA. We are in an environment now where, and this is really important, a MYGA stands for multi-year guaranteed annuity. It's like a CD, but it's afforded tax benefits. If you're, you know, typically if you're older, over 50, 55, it may make sense for you, instead of saving money at the bank at 5%, right? Putting money in, because you're not putting money on that tax return every year. When you get a 1099 on your CD, you're paying tax and therefore chipping away at your nest egg. MYGAs allow you to defer it. You never have to pay the tax until you ultimately start to cash that in and take receipt or constructive receipt of that asset. And then there's index annuities, which are another way to have market gains without necessarily any of the risk of the market itself. So there's strategies there. And then if you were looking at the reduced method, which is cash value life insurance, this is not for the faint of heart. Most people that I run across, they really do not fully understand. Life insurance is complicated. It's written by actuaries and attorneys. This is a textbook that's you know, that, I mean, I have here on my right here, this book here, couple $100. You want some light reading? You want to test your metal? Get yourself a copy of that book. Good luck, right? Because it talks about all the rules. I've been doing this for decades. I understand it. It is complex. And I try and take this complicated subject matter and dumb it down so that we can all understand on how it might fit into our puzzle. So with that said, if we can help you in any way, if you have questions, anything we can do to help you to keep more of your money in your family circle wealth, let us know. Last thing, and I'm doing pretty good. I did it right in 25 minutes. I have Social Security classes coming up at Rutgers. We're almost full, I think. So if it's something you really want to attend, let us know. We'll make a room for you. But other than that, I want everybody to stay safe. Make sure you get your taxes done by Monday. And if you have any questions, reach out. Here's our disclaimers, and we'll go with that. Everybody have a great day.